Well, and that leads us to our next chart that I think is really interesting. And if you're a regular listener of the Get Ready for the Future show, you're going to go, well, you've already told me this, but we're going to keep telling you till you get it and actually respond to it. But if you take a look at this chart from DALBAR, this is the annual study that they do about investor performance versus the market. And if you take a look at this chart, I would direct you to the first column, the average equity return for an investor. And let's take it over the last 10 years. The last 10 years, and this is as of December 31, 2021, over that last 10-year period of time from that backwards 10 years, the average investor earned about 13.44% in an equity portfolio. But the S&P 500 did about 16.55%. And DALBAR lays that squarely at the feet of investor behavior, zigging when they should have zagged, or just zigging when they should have just left it alone, quite frankly. And so when we look at long-term investing, Scott, one of the things that is a hallmark of the Gen Wealth well thought out, crafted investment philosophy is sometimes a portfolio just needs a good leaving alone.
Yeah, no question about it. And, a more productive philosophy is to not try to influence the market, try to make moves when you shouldn't, do the wrong thing at the wrong time for the wrong reason, but allow the market influences to improve your performance. What do we mean by that? Understand that equities are a long-term investment. I think these last 14 months have taught us that, if nothing else, right? If we have short-term investments in the stock market, we could be forced to sell or walk into selling at the worst possible times.
Clearly, and I think we should have learned that back in 2007, 2008. But the problem is, number one, we've got short-term memories, and we get really happy when things are going well, and we think it's always going to be that way. We have something called recency bias that kicks in. And so you've got to be in a situation where you understand the fundamentals of long-term investing, and equities fall into that long-term category.
And what's been interesting in my reviews with clients is when I have clients who are successfully retired, they've reached financial independence, they lived through 2008, they're not the ones panicked. They're the ones that are just like, yeah, we're down. We know it's fine. Because of the strategy that we have in place, those are their funds they don't need for 15 more years. So they're not stressed about it because they've walked through this before.
And that doesn't mean you don't have a model in your investment strategy that does change investments. We're not saying buy something and just let it ride for 30 years, but it does mean don't bail on it when the news is bad, and don't jump in when the news is good.
Scott, I'm famous for saying that what destroys a portfolio is not a bear market, but it's destroyed in a bear market when you sell.
Right.
That is what destroys a portfolio. Clearly, if you hang on to it, history tells us that it will recover. And if you have a long-term perspective, I was just looking at a client's review paperwork that we've got coming up tomorrow. His 3-year average is actually pretty good.
Yep.
His 1-year average is down,
right,
but his 3-year average is actually pretty good. And we should be in this for the long term because retirement is a long-term proposition.
Yeah, you think about that from, you mentioned the term recency bias. I'm going to define that a little bit clearly because it does happen. I've had some clients come in and before we get to that review sheet, they'll go, well, I'm down about $90,000 or whatever it is. And I'm like, well, not really. Let's take a look. What are you basing that on? And of course, they're thinking
the last 12 months.
Their high mark.
They're thinking high water mark.
From the top of the mountain, they've come back maybe $90,000 in that case. But when you stretch that timeline out and go, well, where were we 3 years ago? Where were we 5 years ago? It's a different perspective, and it has to be kept in the long term.
Yeah, they get anchored on that high water mark and think it's always supposed to go up, but it doesn't do that. But when you pull out and take a look at that bigger perspective, it's like I talk about the knothole versus the entire yard of your neighbor. Looking through the knothole in the fence versus looking over that fence, you can kind of get a different perspective.